Now the topic of unit number 2 is risk analysis in capital budgeting. In the last topic, capital budgeting, we have discussed the various techniques available for evaluating a capital budgeting proposal. One assumption was there in capital budgeting, evaluation of capital budgeting proposal techniques. That assumption was there was no risk attached in any project. We are calculating accurately what will happen, how much cash inflows will get in future. But this seldom happens in the real world situation. The future is completely uncertain. First of all, we have calculated cash inflows on the basis of forecasting, and forecasting is based on the future events. Those future events are not at all certain. The future events may be affected due to a number of reasons, like social reasons, political changes, or economical changes, or fiscal changes, and many other reasons. So what we have forecasted, the cash inflows of future may not come true. So this is the risk attached while evaluating a capital budgeting proposal. Normally there is a relationship between return and risk. Higher the risk, higher should be the return. Lower the risk, lower should be the return. So when the project is more risky, the return should be more. Whereas if the project is less risky, the less risk should be applied. So when a project is undertaken, it will affect the business risk. When the business risk increases, definitely it will affect the valuation of the firm. Normally, the investors or creditors will not give much favor to those organizations which will take more risk. So it will affect the valuation. So the management must consider the risk factor. Simple example I will give you. If you deposit some amount in the bank or government securities, you will get fixed rate of interest. There is no risk attached. There is no risk attached. Whereas if the same amount, if you invest in companies, there is risk attached because you are not sure how much dividend you are going to get. So in government securities, we don't have any risk. That's why the return expected from government securities are less. Whereas the returns on company shares, equity shares, is higher because the risk attached is more. We are not sure how much dividend we can be able to get. So in this way, higher the risk, higher the return. Now we'll discuss the meaning of the term risk. Risk is the variability of returns from the expected return. The variability of actual returns over expected returns. If there is no variability between actual and expected returns, there is no risk. Simple example, when we invest in government securities, the actual return and expected return will be same. So there is no risk at all. Whereas when we invest in joint stock company in equity shares, there is risk attached because we expect some return but actually will get something different. So in this case, risk is attached. The variability of return. So every project will have different quantity of risk. All the projects are not equally risky. Some projects are more risky, some projects are less risky. That's why the finance manager must consider the risk factor while evaluating capital budgeting proposals. Now, there are three different types of decision situations. The first decision situation is certain decision situation. Second one is uncertain decision situation. And last one is a risky decision situation. So these are the three types of decision situations. The first one is certain decision situation. It is certain when the cash inflows are 100% accurate. There is no doubt about the expected cash inflows which we are going to get in future. So it is called certain decision situation. But this again seldom will happen, because always the future cash inflows are uncertain. We cannot say with certainty how much cash inflow we are going to get in future. So second type is uncertain situation. Uncertain situation का मतलब ये हो कि we don't know how much return we can be able to get in future. Completely unknown. Even we cannot give the probability of the happening, possibility of happening of the event. जो event होने वाला है उसकी probability कितनी है वो भी नहीं दे सकते. Example, first time we are starting a business, we don't have any idea about the business. First time we are starting, we don't know what will happen, what will be the demand in the market. We don't have any experience, we don't have any past data. So in this case, the situation is uncertain situation. Because we don't know what will be the outcome, we cannot give any probability. This is called uncertain decision situation. Last one is risky decision situation. A risky decision situation is that situation where the future outcomes are uncertain, but we can give probability to those uncertain events. Example, we are already in the business since last so many years. Now current year we are launching a new product. Now the new product may be absorbed with full demand, high demand, or medium demand, or low demand. So we can give the probabilities to these three events. What is the probability of high demand? What is the probability of medium demand? And what is the probability of low demand? Because already we have the experience. So we can assume how much probability is there for each of the events. So this type of situations are called risky situations. And normally in a business organization, most of the decision situations are risky situations. So in this way, we have classified the decision situations into three types. Now we are coming to the point how to incorporate the risk factor. What are the measurement techniques of risk? See here, incorporating risk is very important while evaluating capital budgeting proposal. But incorporating of risk is not an easy task. A number of methods are there, number of complications are there. How to incorporate the risk in the capital budgeting decision? So broadly we have five measurements, five types of, five methods are there for incorporating the risk. One by one we'll discuss. First is risk adjusted discount rate, RADR. Risk adjusted discount rate. While discounting the future cash inflows, we will adjust the discount rate. If the project is more risky, we take a higher rate of discount. If the project is less risky, we'll take a lower rate of discount. The discount rate we will use according to the risk of the project. So we classify the RADR into two parts. The first part is risk-free rate. Second part is risk premium. If there is no risk at all, definitely we'll take the risk-free rate. Example, 10% definitely we are going to get. At any cost, we are going to 10%. We are going to get 10% rate of return. So this is called risk-free rate. But the project involves a little bit more risk. So we add some premium to that risk-free rate. Suppose 5% is the risk attached. So 10% is risk-free rate, 5% is the premium, risk premium. So RADR will become 15%. In this way, we incorporate the RA, risk adjusted discount rate, in order to adjust the risk factor in capital budgeting projects. This is called RADR. This is a simple method of incorporating risk in the investment proposal. Second one is certainty equivalent, CE. According to this method, we'll use certainty equivalent to bring down the cash inflows to a conservative level. To bring down the cash flows to a conservative level, a reliable level, realizable level. So how we can be able to bring down? By using a correction factor or certainty equivalent coefficient. By using the certainty equivalent coefficient, we try to bring down the cash flows to a conservative level. So how to calculate this certainty equivalent? There is a formula: risk less cash inflow divided by risky cash inflow. The ratio of risk less cash inflow divided by risky cash inflow. This ratio will give you certainty equivalent coefficient. For example, if the management says from this project we can be able to get 20,000 rupees cash inflow every year, but In that 20,000, minimum 12,000 definitely we are going to get without any risk. 12,000 is riskless cash inflow. 20,000 is with risk cash inflow. So we'll take a ratio 12,000 by 20,000. You'll get 0.6. Certainty equivalent coefficient is 0.6. Now this 0.6 we will make use to bring down the cash inflow to a conservative level. So for every year we have to calculate one coefficient, certainty equivalent coefficient, and multiply this certainty equivalent coefficient with the cash inflow. Then we'll get the expected cash inflow. These expected cash inflow will make use to calculate the NPV, IRR or any technique. So this method is called certainty equivalent coefficient. Next is sensitivity analysis technique. See here, in the previous method, one cash inflow is calculated for every year. But some author says it is risky to take only one cash inflow for every year. Instead of one cash inflow, we take 3 cash inflows every year, so that the variability of cash inflows we can be able to take into account. The 3 cash inflows which we take is optimistic cash inflow, most likely cash inflow, and pessimistic cash inflow. So for every year, instead of one cash inflow, we calculate 3 cash inflow. 3 cash inflows. Optimistic का मतलब ये है कि highest cash inflow कितना आ सकता, how much maximum cash inflow we can be able to get. For example, in a project the maximum cash inflow is 80,000. So we expect 80,000 maximum cash inflow in a particular year. The pessimistic cash inflow is, let it be 20,000. 80,000 is the highest, 20,000 is the lowest, and in between most likely let it be 40,000. So 40,000 is the most likely cash inflow. So in this case, instead of one cash inflow, we calculate 3 cash inflow: optimistic, pessimistic, and most likely. On this basis, according to the variation between optimistic and pessimistic, we can decide how much is the risk attached. If the variability between optimistic and pessimistic is high, that means it is more risky. If the variation is less, we can say less risky. So this method is called sensitivity analysis method of incorporating risk. Next comes probability theory approach. One of the drawback of sensitivity analysis is we are not assigning any probability to the value of to the event of optimistic, pessimistic, and most likely. We are not giving any probability value to those 3. Simply we are taking how much cash inflow we can get in optimistic situation, pessimistic, and most likely. But in probability theory approach, we assign probability to each and every cash inflow. We can take any number of cash inflows. For every year we can take any number of cash inflow, but for every cash inflow we assign a probability. Example, we have calculated 4 cash inflows for first year. First year the cash inflow may be 10,000, 20,000, 15,000, 30,000. Like that 4 cash inflows we have estimated. For every cash inflow we have assigned a probability. The possibility of happening of that event, that is called probability. The chance of the happening of that event is called a probability. So 10,000 rupees is the cash inflow. The probability of getting this 10,000 is 0.2. The 0.2 means 20% chance that the cash inflow will be 10,000. Second cash inflow is 20,000. The probability is 0.3. The 30% chance the cash inflow will be 30,000. Like that, for every cash inflow we assign the probability, and multiplying the probability with cash inflow, we can get the expected cash inflow. In this way, we can be able to incorporate the risk by using probability theory. The maximum probability value is 1. 1 का मतलब ये होता है कि definitely that event is going to happen. If we give one probability, that means the cash inflow is definitely going to happen. No change at all. If the probability is 0, it means the event will never occur. That cash inflow will never occur. The probability will be 0. So normally probability will range from 0 to 1 in between. This method is called probability theory approach. Last approach is decision tree approach. This is a graphical method of evaluating the risk in capital budgeting proposal. It's a diagrammatic method. A decision tree is a normal tree which is horizontal. Normally, practically, the tree will be vertical. But here in theory, we draw the tree horizontally, showing the branches of alternatives. For example, in the case of two decisions, whether to make product A or product B. So first of all, from the decision, we have two branches, either make A product or B product. Suppose if we make A product, there are three possible events. The demand may be high demand or medium demand or a low demand if we make A product. Similarly, if we make B product, again the demand may be high demand, medium demand or low demand. Now we have to assign the probabilities. How much is the probability of high demand, medium demand, low demand? Then we calculate what are the consequences. If we make A product and the demand is high, how much cash inflow we can get? If we make B product and the demand is medium, how much is the cash inflow? If we make A product, demand is low, how much is the cash inflow? So we have estimated cash inflow for each of the events. Now we multiply the probability with the events to get expected cash flow. Expected cash flow. So by taking those expected cash flow and then subtracting the cash outflow, we can get the NPV. So this decision tree diagram will give a pictorial view of the decision making situation. So we can evaluate the decision in a better way by drawing that decision situation in the form of a tree, horizontal tree, which goes from left to right. This is the complete explanation regarding risk analysis in capital budgeting. How to incorporate the risk. While doing the problem, we'll have the problems on all these techniques. Some problems will be on RADR technique, some problems will be on sensitivity analysis, probability theory approach, as well as decision tree approach.